Welcome to the Killik Co podcast for Monday the 24th of June. Quick look back at last week. We had the speech from Ben Bernanke where his language was more committed to the cause of tapering of QE under certain circumstances. So going into that speech, if there were thoughts that he may be looking to soften the message and indeed provide some relief to markets, well, he did quite the opposite, and as a result US 10-year yields rose significantly and equities dropped off, particularly across the sort of emerging markets. We also saw quite a sharp spike in some of the interbank rates and 7-day lending rates in China, which caused a little bit of a stir. We'll take a look at the charts there as well. But as I say, we certainly see much rockier patches for all asset classes at the moment. Some big movements in currencies, obviously some very big moves in bonds, which is impacting on some of the periphery countries, and of course equities are retreating quite fast as a result. Whilst there are still some positive gains in the Western world, they're sharply reduced from the peaks that we saw during mid-May. So let's have a quick turn to some of the charts. We'll start off with the forward-looking diary, and really the main message here is in terms of expected releases, it's going to be much thinner on the ground, so I hope for less sort of noise from some of the decisions on rates or indeed some of the speeches. There will be a couple of Fed Reserve speeches on Thursday which will be looked at closely. Some of the Reserve members are talking, but Germany does to some extent take the lead role this week in some of the data that they'll be sharing with us. We've already seen some business confidence data that has come through. They're largely in line with expectations. That came out, as I say, on Monday morning, but we'll have some employment numbers and also some inflation numbers coming out, so maybe attention turning a little bit to the data coming here for potential ECB action. So let's look at some of the charts, and unapologetically we will be looking more at the macro issues for the week, and starting off with that all-important 10-year chart. We've repeated this now for 2 or 3 weeks, and we just need to keep it very close to our screens at the moment, because it is largely determining what is taking place around the world in terms of other asset classes. And this yield, responding to Bernanke's speeches, has moved nearly 1% now, from a low of 1.6%. We're touching 2.6% this morning, so these sort of sharp moves in the risk-free asset are now having impacts across most of the asset classes that have been priced off that in the past. So taking a look here, this is just as an example what is happening in Spain. Clearly some very neat footwork that has taken place right across the periphery since the speech last year of Draghi's speech, which indicated he would do everything to support those periphery countries. Well, we saw yields come in from 7.5%, touching a low of 4%, but we're back out to 5% at the moment, and one would argue that the sort of spread between Spanish debt and the US probably, whilst being sort of maintained at 1%, surprised that the Spanish yields have not sort of pushed out a little bit further last week. We did have some bond auctions in Spain last week. The cover, bid to cover, was a little bit lighter than expected, and that also added to the rise in yields in Spain. Looking at currencies, because clearly currencies are moving around quite sharply, this talk of strengthening policy in the US at the moment is only making it more dollar attractive at the moment, so most currencies coming off quite sharply against that. The euro, certainly one of the major currencies here, topping out at 134 recently, down sub 131 at the moment, and if we continue to see that trend underway, there will be some ramifications for that, and some quite positive potentially for exports out of Europe with the softer currencies. We have been seeing that in April Spanish exports were growing 17% year on year, so certainly that aspect of their economy seems to be coming back at the moment. And also in Italy we saw some consumer confidence data this morning coming in way above expectations. So maybe we're just seeing some indications that a few of these movements are assisting in certain parts of their economy. This chart represents really just a sort of broad measure of emerging markets, obviously as risk appetite is receding quite rapidly across the globe. It's those emerging markets that are taking most of the hit at this stage. So this is really an indication of some of those markets, how quite sharply they are coming off at the current time. Wanted to take a quick look at the UK. The UK has been hit quite hard, although not quite as hard as some of the emerging markets that we have seen. But at its peak, the FTSE was up around 15 to 16% at this point. We are now sort of holding on to a 2 to 3% gain on the year. So we've come off quite sharply, and commodities have played a part in that, of course. But nevertheless, it gives an indication of the level of reversal that we have seen in the UK market. The US, however, has held up much better. This is a chart of the S&P 500. And we can see there that having peaked out just above 1650 here, we're still holding on to 1592 on the S&P as of this morning. Think back to where we started the year; it was around about 1400. So the S&P index really showing some very healthy gains over the course of the year, and really has provided sort of full proof of a good case of diversification on equities into the US region at the moment. Their economy certainly being well represented through that S&P index at the moment. In terms of one chart that has caused a little bit of a stir around and about, this is the Chinese equivalent of the LIBOR. This is the 7-day lending interlending market between banks, and we saw a very sharp spike there at towards the end of last week, indicative of a potential credit crunch in China. There is a talk over from Sunday evening that central bank intervened to assist, and that's why we saw the very sharp reversal, but still remaining at fairly elevated positions, and that did cause the Chinese stock market to fall by around 5% overnight. So it's not just 10-year bonds that are causing some wobbles at the moment, but certainly taking a sort of increasingly close eye on the banking system in China at the moment. This is the commodity index. I mentioned about the fact that the UK has given up a lot of its gains. It is more commodity weighted, and this CRB index has really touched a sort of new low last seen sort of 12 months ago now. So that reversal continuing to come under some sort of pressure at the moment, slightly working counterintuitively somewhat to the recovering economy story, which is leading us all to start to see higher yields around about and potentially a sort of tapering of relief. So there are some very mixed messages that are coming out at the moment across the markets. That's why this level of uncertainty is causing much heightened levels of volatility in asset classes, and will take, I suspect, a few more weeks to settle down. Finally, just one stock that we are highlighting in our morning meeting as having come off very sharply, and this is United Utilities. Obviously, all the utility stocks are being hit somewhat by the rising bond yields, often seen as a sector that trades off of bond yields. So as yields rise, equity prices tend to fall. But having come off from 760 to 651, we're going to put a toe in the water with a trading buy out on United Utilities this morning.